Thank you to Livewire to invite me to these things. I don't know whether it's people like my content. I'm just generally quite rude at people, but it goes down quite well. Biggest issue. So James mentioned that you guys had a poll earlier, and it was all about quantitative tightening and disinflation. Well, that's what I'm here to talk to you about today. The biggest issue we see is this chart here. Now, this is equity market volatility. Now, I could have put up any market vol. I could have put GDP vol, I could have put bond market vol, FX vol. There's so many different indicators which are showing great suppression right now. This is a 6-month moving average of the VIX, which is S&P traded volatility. And you can see it's back down at the lows we saw just pre the GFC and how it's very, very suppressed. Now, there's a reason this has happened. Now, also, if you think about what's happened in that period, you can see the blip in 2011, which was the European crisis. And then we had the small blip in 2015. But you look at back in early 16, and that was when we had the Chinese devaluation and the large fall in the equity market, and it virtually didn't show up. Now, there's technical reasons why this is happening, and there's a new class of investor that are in this market that have never been here before, and that's the large ETF and vol selling funds and the hedge funds that operate in this space. Now, to give you an idea, you can make better returns now selling vol forward and then rolling it down short and doing that as a systematic strategy than you can actually yielding on an investment-grade bond in the US. And that's why this whole new asset class has popped up, and it's been suppressing vol so much. But the other thing that's been suppressing vol is the massive amounts of money that have been pumped into the system by the quantitative easing packages we've had across the central banks. Now, we knew that the BOE, the Bank of Japan, and the Fed, and the ECB to a lesser extent have been pumping money in since the GFC. Would you know that the ECB's balance sheet is now the largest in the world? It surpassed all the other central banks just a couple of weeks ago. And that's because they're continuing on their quantitative easing package when everyone else is stepping back from theirs. Now, what they did is they had to do quantitative easing because we're coming into the Great Recession, so the GFC. Now, it was very good at stopping the economy going from -2 to -5 and turning it into a depression, but monetary easing or quantitative easing has actually been proven to be very, very bad at trying to get your growth rates up from 1 to 2 or 2 to 3. But that's what they've been doing. And we've been in an era of slow growth where arguably, as we're coming through the back end of a financial crisis, you should have fiscal policy loosening. But because all the governments in the world were focused on fiscal austerity, you had no loosening of fiscal policy, so all of the heavy lifting came down to central banks. And if all you have is a hammer, everything looks like a nail, and they banged that QE hammer as much as they possibly could. And now you can argue in a world where increasing quantitative easing is actually slowing growth. And it's decreasing productivity, it's reducing capex, and it's actually causing the things it's meant to solve. And that's a massive problem. And that's why central banks are talking about stepping back from their quantitative easing packages. So post-Sintra in Portugal a couple of weeks ago, we had the Bank of Canada hike rates, we had the ECB, the Fed, and the MPC, Bank of England, all talk more hawkishly. So there seems to be a coordinated response about getting interest rates up, or at least stopping the monetary easing. And I think this is a focus on financial stability, because what's happened is quantitative easing was there as it was supposed to push down yields on bonds and force people out the risk curve. It's called the portfolio rebalance effect. But the problem is it worked too well. And what you've done is you went to quantitative easing, then you went to negative rates, and you've pushed yields so low down on government bonds, and then you've pushed people so far out the risk curve, you've compressed all asset yields in the world, and they're virtually converging on zero now. So if you look at a balanced portfolio, 60-40 in the US or in Australia, it's unlikely to return you a real return over the next 10 years. That's how bad and how bad yields are and how richly priced assets are right now. And that's a function of quantitative easing. Mervyn King, the then governor of the Bank of England, talked about it as bringing forward future asset class returns to today. Well, they've done that in spades. And what they've done is they've compressed volatility. So central banks want to hike rates. The Fed has got a meeting tonight. They're probably going to come out hawkish. And they've told you explicitly They want to do 1 more interest rate hike this year and 3 next year. So that's 100 basis points on rates, but the market doesn't even think they'll do 2 rate hikes by the end of next year. So why is that? Why is there this disconnect between what the Fed's telling you and what the market expects? And it's due to this. It's disinflation. We can see here on the left-hand chart how important the oil price has been to the inflation rates. So since mid-2014, the oil price has driven up headline inflation rates across the world, and I'll just use Europe here. But since we've seen late 15, early 16, we've seen a 50% fall in the oil price, and that's what's pressuring inflation rates down now. That's why we're seeing disinflation. But it's not only the oil price. If you look at the charts on the right, you can see that everywhere in the world is suffering from this disinflation. And that's due to technology disruption. It's due to changing working practices across the world as we move from full-time to part-time workers. And it's due to lower productivity and lower capex. And all of this under the umbrella of much higher debt. And total world debt now is higher than it was pre-GFC. So what central banks have been trying to do is to goose GDP growth up by forcing you to take more debt, but it reaches its ultimate limit when the world doesn't want any more debt and it's unable to sustain it. So if the central banks do want to increase their interest rates, or they want to, in the case of BOJ and the ECB, reduce the size of their monetary easing, what does that mean? Well, we know, and you saw it from the first chart, that when they pumped huge amounts of money into the system, it dampened volatility. So by definition, if they're taking money out of the system, it has to increase vol. We could see from this chart, which shows you the Chinese credit impulse relative to the VIX, there's a good reason for the VIX to start picking up now. Now I can show you 20 or 30 other charts, all of them showing you that equity volatility is super cheap. And you can see that because it's at 9.5 on the VIX, the lowest it's been since 1993. And I showed you on that earlier chart that the 6-month moving average is the lowest it's pretty much ever been in history. So we know vol is cheap, but I would argue that we're at a point where vol should start picking up now. Now to clarify, that doesn't mean that I think equities are going to fall. I just think there's volatility coming back into this market. And by definition, there has to be if we move into a world where we're talking about monetary easing to a world we're talking about monetary tightening. So as volatility comes back to the market, the one asset class you've got to be really concerned about is credit. Now, credit up until now has been arguably the best performing asset class. It's got the high Sharpe ratios, and it's got everyone who look at the yields, because what's happening is because credit bonds sit on the income account, that the capital gain actually is classed as an income, so they look like they've got great income numbers coming through. But the problem is, as equity market volatility picks up, it's a direct input to credit valuation models. So as equity market vol picks up, the chance of default increases, and therefore credit spreads have to widen. And we're now at the lows of credit spreads we've seen post-GFC, and in some markets even pre-GFC. So credit looks incredibly rich because it's part of this search for yield, but we would argue this search for yield will now go into reverse as the Fed starts to hike interest rates. So this is a weird situation where you've had the central banks forcing you out the credit curve, and now they've created a monster, a Frankenstein monster of their own making. They wanted you to rebalance into all this credit and low-grade securities and go out the risk curve into EM, but now they're worried you've gone too far out the risk curve, and now they're worried about financial stability. But no one believes them, because at the first sniff of any deflation, we believe the central banks will roll back, and they won't tighten as much, or the first whiff we get of equity market volatility, the belief is that central banks will stop hiking and actually cut rates again. But what happens if this time it is actually different? And the central banks do want to hike interest rates, and they do believe that interest rates, the low interest rates are forcing risk-taking behaviour, which brings with it financial instability risks. And as a group, they do want to hike rates. Well, in that environment, you will get increasing volatility. You will see it in rising bond yields initially, certainly the back front end of the curve. I would argue that given economic growth is lackluster, the back end will be reasonably well supported. and you'll see it through widening credit spreads, and you'll see it through rising equity volatility. So as the big picture, if I just want to focus on one thing, the market is trying to tell you quantitative easing is not going to be a big deal. The Fed tells you quantitative tightening is not going to be a big deal. The Fed says it's going to be like watching paint dry. But we've never tried this before. And what happens if it isn't like watching paint dry? Thank you, James.